What's up, everybody? This is Dejan, owner of Tinae's Wealth Management and Credit Consulting. And today's video is about how to pick the best stocks. Now, I know I've received a lot of direct messages. I received a lot of comments on Facebook, Twitter, Instagram, and a number of other platforms. And I really want to talk to, a lot of you guys about the importance of selecting the best stocks. But before we dive into that, check out my latest books, The Principles of Stock Market Investing, The Essentials of Good Credit, and Life Finances and Opportunity. Each of these are available on Amazon, and I would love if you guys could check it out. And I also have my latest 3 books, The Power of Investments, The Finance Alphabet, and The Importance of Budgeting. Each of these are also available on Amazon, and I would love if you all could take the time to actually go out and support the movement. So if you do purchase a copy, definitely reach out to me and send a picture because I love to see who all my supporters are. And don't forget to hit that like button and subscribe to the channel. So let's dive into it. So when it comes to choosing the best stocks, I usually tell people you want to use fundamental analysis as well as technical analysis as much to your advantage. But just for the purpose of this, I'm really going to stick mostly to the fundamental aspect of it. So first things first, pay attention to earnings growth. Earnings growth is one of the most important things to pay attention to because earnings reports comes out every 3 months, and that shows you the quarterly updates on what companies are doing. So I usually tell people don't stress yourself out trying to really understand what a lot of these terms mean. Be sure that when you look at earnings per share when it comes to financial statements, that you're seeing either rapid increase or consistent increase in these earnings per shares, because if you see it declining even slightly or it's just constantly declining, that investment choice may not be the best for you. So I like to tell people when it comes to earnings growth, it's real simple. Look for it to go up. If you see it declining or staggering lower, you know it's not the opportunity for you. And to me, that's one of the most simplest things because they give you constant updates over a period of 3 months. So one of the most important things to pay attention to. Number 2, as I always tell people, you want to know if a company is leveraged by not just debt, but also equity. When it comes to the debt to equity ratio, it's to show if a company is leveraged with more debt or more equity. So in this case, when you see companies that are over leveraged by debt, to me, that's a key indicator that that company might not be the best investment choice. Now, why? Now, most companies that are funded by debt, they usually fail, especially if they're startup companies too. They usually fail fairly fast. Or if they're leveraged by debt, they usually have a hard time becoming profitable. So not only does it make it hard for the business itself, but companies that are over leveraged by debt have a harder time returning any type of money to their investors. So if I invest $1,000 into a company that has a severely high debt to equity ratio, then I already know I probably don't want to deal with that company because those debt levels are probably too high. And my opportunity for receiving a return might not be what I'm looking for. So I may go seek other opportunities after comparing whatever company that may be of my choice against 2 other companies that I may want to benchmark. Now, the third thing I really want to talk about that really lets you determine if a stock is worth buying, you have to ask yourself this: does this stock pay a dividend? Now, all stocks don't pay dividends, don't get me wrong, because some people may mention Amazon, Tesla, and other large companies. Those are growth stocks, and growth stocks may not for the most part pay a dividend to anybody. But I'm not saying it's not worth buying. What I'm saying is companies that have longevity, like Apple, like Coca-Cola, like Disney, like AT&T, they pay really great dividends, not because they're decent companies, but because they've been along for so long and they have the capital available to distribute any type of excess funds just for holding that stock. So if you hold a stock that pays you a dividend, that's a good sign. Now, keep in mind, just because the stock pays a dividend does not mean that that stock is good as well. Because, for example, I'm sure everyone has seen GameStop. GameStop stock was probably one of the worst stocks out there. And this is not even considering what recently happened with the Reddit ordeal. So disregard the Reddit ordeal. Let's just focus on GameStop primarily. GameStop paid a really great dividend from maybe 2015 to maybe 2017. Don't quote me on that, but I know the dividend was pretty high. However, if you go back and you actually look at GameStop's charts, it was downtrending. So just because they were paying a dividend didn't mean that that company was consistent or worth investing your money into. So when you actually look at companies like Apple, like Microsoft, like Coca-Cola, like AT&T, they're positive uptrending companies. They're not companies that you're just putting your money in and they're remaining stagnant or just consistently declining while paying you a dividend. If it's consistently declining and paying you a dividend, it's just minimizing it just a tad bit, but you're still losing money on the trade. You want it to continue to climb as it's paying you dividends, so that that dividend can factor in most of your return or play a significant portion of that. Because let's be real, the stock market dividends have returned a wide or a vast majority of the returns to investors. So keep that in mind, that dividends will always be important. Some people may invest in companies that don't pay in dividends, some may, but it's all about going back to the fundamentals and evaluating if the company is worth investing for the long term. If so, that dividend can be really significant for you in your case. So don't forget to look at companies that are paying consistent and increasing dividends, because that can be a really good sign, especially if that company has been performing well over time. Now, this takes me into my next point, strong leadership. And strong leadership is really important for a company, because if you see constant change or anything like that, you already know that company might not be the best fit for you, because there's constant turnover in management. There's not any true direction. People are constantly coming in and coming out. So it doesn't really impact the company in a great way. Now, strong leadership, what I like to tell people is a great example is when Steve Jobs passed away, rest in peace, and left Tim Cook in charge of Apple. One thing I really like about Tim Cook, I feel like Steve Jobs left one of the best people in charge, because Tim Cook is really strategic. He's really intelligent. And I think a lot of people don't pay attention to that. So I feel like Steve Jobs, as not only the CEO of Apple at the time, back in like 2010, 2011, he left a strong leader to take over Apple when his time was up. So it's having Tim Cook in Apple was really effective for that company, because he was able not just to grow Apple, but he expanded it. And now they're looking into new things in the future, especially with Apple cars and things of that nature, getting through the pandemic successfully, still being able to keep itself afloat. Strong leadership like that is important, because it keeps the company afloat. I think a lot of people underestimate the power of leadership, and I honestly believe it's probably number one at the list in terms of investing in an effective company. Number 5, long-term strength and stability. So taking it back to what I was saying before, you want low debt levels and you want growing revenues. That can also lead you to, like I said before, earnings growth. You want growth, you want revenues, you want declines in expenses, you want declines in liabilities. You want to put yourself in the best position as possible to minimize your debt while increasing your revenues and building your assets. That is a strong performing company. Next, I usually tell people this all the time, no matter what anyone has to say. Buy what you know. Don't buy what Bob told you across the street. Don't listen to all the speculation on stock twists. Don't listen to people on Facebook. If they're not Series 65 certified, they're not financial advisors, or they're not really a respectable or reputable individual, don't listen to them, because a lot of people get burnt and lose money following a lot of stuff that's on the internet. And let me tell you the truth. Everyone's a genius in a bull market. So when the market is constantly going up, everybody's going to be right to an extent. But what determines if someone's really good at what they do is if they can cash flow positive in a downtrending market. That's where you separate the average from the great. So make sure you put yourself in position to understand what you're doing, because a lot of stuff that's out on the internet is not worth putting your time into. And I want people to understand that as they're moving forward in their investment career. Number 7, as I tell everybody all the time, you want to put yourself in a position to maximize on your money. So for those that may be newer to, investing in things of that nature, look into exchange traded funds, or better known as ETFs. They're mutual funds trading on the stock market as if it's a stock, long story short. ETFs like SPY, which represents the S&P 500, those are basically a composite of a variety of stocks put into one fund. They trade just like just like mutual funds. So the only difference is it trades on the open market. So for any newbies out there, any rookies, anybody that's looking to get their foot into the game, look into exchange traded funds. Look to invest your money in diversified options because that will minimize your risk. Don't just go out and throw money at all these speculative stocks that people talk about on the internet, because you'll have an opportunity to lose your money faster than what you really think you could do in terms of making it. So don't put yourself in a position to listen to all the yap that's on the internet, because a lot of people don't give effective game. So just take that moving forward. Lastly, just to leave you all with a good tip moving forward, study fundamentals. If you are not the best person in terms of evaluating the numbers or looking at statements, keep in mind, you don't really have to know what a lot of this stuff means. You just need to know if something is going up, then it could be a good thing. And if it's going down, it's a bad thing. So if you see revenues going up, you know that's a good thing. If you see liabilities, let's just say they're increasing, but they're staying somewhat consistent, you know, that's a good investment, you know, especially if the revenues are increasing, the expenses are somewhat stagnant or relatively increasing a tad bit. You know, those are good investments, but don't go out and confuse yourself and see something like you see debt levels increasing drastically and you see revenues are not really increasing. It shouldn't be rocket science. You know, it's easy process of elimination. Figure out what you know and use it to your advantage. If you don't know it, get rid of it. Don't pay attention to it and move on to the next opportunity. Don't stress yourself out or make it hard, because a lot of people stress themselves out investing, thinking, you know, what stock should I buy? Buy what you know. It's the same thing. Look at the numbers. Determine what you think can last long in the long run. Analyze the numbers again. I have to say it again because it's one of the most important things I think people leave out. So for myself, just leaving you all the best advice that I could really give you. Morningstar is one of the best websites that you can get. It'll break down all of the numbers that you're looking for in terms of return on assets, return on equity. You know, they're going to give you debt to equity ratios. They're going to give you all the statistics, all the financial data that you'll need. So you're not going to have to number crunch anything. It's going to be flat right there in your face on a yearly basis. Or if you want to look at quarterly type of information, go to Morningstar. That's one of the best bits of advice that I can give a lot of you guys that's watching my channel today. So I did want to leave you all off on that last point. And just to reiterate the key points: earnings growth, debt to equity. Does the company pay a dividend? Do they have strong leadership? Do they have long-term strength and stability, which is a combination of both paying attention to debt levels, revenues, expenses, and things of that nature? And then lastly, buying what you know. Buy what you know. Don't buy what you hear. There's a lot of gurus on the internet. I'm going to say it again. There's a lot of gurus on the internet. Everybody is not giving the best advice. Everyone is good in a bull market. Don't put yourself in a position to fall for the propaganda that's put out through fake articles. Always bring it back to the numbers. Don't listen to these gurus. They're just trying to run up stock prices to sell the stock so they can decline on you and you lose money. And if you don't believe me, go on StockTwits and you'll see it happen every single day. Stocks are manipulated all the time, especially these penny stocks that people like to get into that have they usually like to say low risk, high reward, but in my eyes, I feel like it's just an opportunity to pump up stocks to benefit someone else. So don't fall for any of that stuff. Just focus on long-term investments that are quality, and you'll be successfully invested in the stock market. So thank you again to everyone that has watched my video, and I look forward to dropping more content soon. Y'all stay blessed.